we will be focusing specifically on IRA planning for baby boomers. If you have any questions, I definitely would advise you write it down, maybe send us an email or give us a call, and we can schedule a time to talk about any questions you have. With that being said, both Kevin and I are under the kind of watchful eye of First Heartland Capital. That's our broker dealer. That's who we offer securities through. So one disclaimer or disclosure there. SOFA, the Society for Financial Awareness, we don't offer to sell anything. There's no pressure or anything along those lines. Our goal, both Kevin and I, is simply to speak in the community and offer people information that we feel will help their retirements and help them make better decisions within their retirement. So that's basically the only goal we have, is just to help you make a better decision with information you probably didn't have, or maybe you had misinformation, that type of thing. So some common questions we get a lot, both Kevin and I. Can I still contribute to an IRA? To what age can I do that? How much? That type of thing. We'll go over all of these questions within the presentation. What type of IRA is right for me? When do I need to take withdrawals and how much? How are my IRA withdrawals taxed? What happens when I die? How do the new tax laws impact me? And how can I minimize taxes? For that last one, obviously, it's kind of a well. We're just going to skip over it, kind of like a pond. If you are interested specifically in taxes within the scope of your retirement, and I guess even before that, definitely let us know. We have a tax seminar that we run, I believe, about once per month, maybe every other month, but we can get you signed up for that. Tax is super important to your retirement. It's always, there's always going to be a chunk of your assets that are allotted to paying taxes. So some basics for a traditional IRA. Contributions may be tax deductible. We'll go over how and when they might be. Savings grow tax deferred while it's inside the account. So after you contribute to the account on a year-to-year basis, you do not get a 1099 for any dividends or growth capital gains within that account. However, when you make a withdrawal from the account, those are added to your taxable income for that year. So if you take $10,000 out of your IRA, it's like you earn $10,000 more on the job. Caveat there at the bottom: withdrawals made prior to age 59 and a half may be subject to an additional 10% early withdrawal penalty. Most likely would be subject to that penalty, except for a few kind of specific situations, but strongly advise we wait till after 59 and a half. Traditional IRA contribution rules. So the maximum you can contribute for 2021 moving forward is $6,000. There is a $1,000 extra, what's called a catch-up provision if you're 50 or older. So you can contribute $7,000 if you're 50 or older, basically, in that situation. You must have compensation, generally earned income. So that doesn't mean Social Security. That does not mean pensions. If you take money from your IRA, that is not earned income. It's basically W-2, that kind of earned at your job type of compensation. So none of the Social Security, pensions, or any of that will count as compensation for contributing to an IRA. We do get that question a lot. Beginning for years 2020 and later, there is no longer an age limit for making contributions. It used to be 72. Well, it used to be 70 and a half, then it was 72, and now there is actually no age limit for making traditional IRA contributions. You can continue those even when you're taking required minimum distributions. But again, you can't count the required minimum distribution as compensation for purposes of contributing. So when are contributions deductible? They're basically always deductible unless you and or your spouse are active participants in an employer-sponsored retirement plan. So when we mean employer-sponsored, we mean 401k, 457, 403b, those types of plans, and your income exceeds an applicable threshold amount. So you can still be contributing to a 401k, 403b, unless both of those things are true. So we'll move on to Roth IRAs. So conversely, there is no deduction for contributions when you contribute to the account. It's after-tax money. Savings grow tax deferred while inside the account. That's the exact same as a traditional IRA. Contributions may be withdrawn at any time, tax and penalty free. So any money you put into the account, you can take out tax and penalty free. That does not include growth on the account. Qualified distributions may include earnings and are also tax-free. So qualified distributions, meaning after age 59 and a half, and after the Roth IRA has been open for 5+ years. Maximum contribution is the same as a traditional. Must have compensation, again, the same as a traditional. There's no age limit for contributing. However, unlike a traditional IRA, there are income limits that will stop you from contributing to a Roth IRA completely. Single filers can make a full Roth IRA contribution if their income is below 125. Married couples, it's under 198. If you're under those, you can contribute fully. If you're over that, it starts to phase out how much you can contribute to a Roth IRA. Spousal IRA / Roth IRA contributions. Basically what this means is if your spouse does not have compensation, you can still contribute to his or her account via a spousal contribution. You just have to have earned income that shows $14,000 or $12,000 if you're under 50. So you just have to meet the same criteria as before. However, even if your spouse does not have compensation, then you could contribute to what's called a spousal IRA. Take advantage of employer-sponsored retirement plans. If you still work, check to see what retirement plans your employer offers. You can contribute money to an employer-sponsored retirement plan and an IRA / Roth IRA. You can always contribute to both a employer-sponsored retirement plan and an IRA. Just it may mean the contributions are not tax deductible. However, as we saw earlier, you might not be able to contribute to a Roth IRA at all if your income's over a certain level. The salary deferral limit for 401k and other employer-sponsored plans for 2021 is $19,500. However, there is a $6,500 catch-up provision if you're 50 or older, similar to the $1,000 catch-up provision in an IRA. So 6 rollover options for your plan funds. This is, when you're leaving your employer or if you're retiring or in service distribution. So 1, leave your employer plan assets in the existing company retirement account. They'll still service it in most situations. Generally, you'll pay a fee for that. Roll over plan assets to a new company retirement plan. So basically just roll your 401k into your new 401k. Roll the old 401k into an IRA. Take a lump sum distribution of your plan balance. Convert your plan assets to a Roth IRA, or make an in-plan Roth conversion of your plan assets. So most people are going to do the first 3. In any of those situations, there is no taxable event. And number 4, however, if you take a lump sum distribution of your plan balance, if you're over 59 and a half, the worst that happens is you'll have to pay tax on the entire amount at your income rate. If you're under 59 and a half, of course, you'd pay tax at your income rate plus a 10% penalty. If you convert plan assets to a Roth, we'll go over that in a little bit, but basically that'll also be added to your taxable income. But then it'll be in the Roth, that'll grow tax-free, and you can take it out tax-free, and then make an in-plan Roth conversion of your plan assets. Again, each of these have kind of pros and cons. If you're interested in doing, if you have money in an old 401k that you need to think about, what you're going to do with that, feel free to schedule, a call, complimentary meeting with either Kevin or I as part of, as our gift back to the community. If you do attend one of our seminars, we offer a free complimentary meeting just to go over really anything you would like, but in this specific situation, what to do with a retirement plan. So potential side effects, not really side effects, just kind of what happens when you do an IRA distribution. You might get exposure to the 3.8% surtax on net investment income. That's basically added to any capital gains, which would normally be taxed at a lower tax rate. You might get hit with this 3.8% surtax if your income hits certain thresholds. Phase out of deductions and tax credits because, again, it's added to income. Increased Medicare Part B and Part D premiums we see all the time. It's called the Income-Related Monthly Adjustment Amount, or IRMA for short there. Essentially, once your income gets to a certain bracket, your Medicare Part B and Part D premiums go up. And, you'll add a surcharge to that, similar to the surtax on net investments. Increase the amount of taxable Social Security benefits, reduce or eliminate financial aid for a child's education, reduce or eliminate Roth IRA contributions eligibility, and more. So all of these, I guess, are the negative side of taking money out of your IRAs, but they're things, that are going to happen. You need the money, so they're just, things that we have to deal with. Required minimum distributions. So avoiding IRA withdrawals allows your account to grow tax deferred for as long as possible. It keeps income off of your tax return. However, you cannot avoid the withdrawals forever. At a certain point, because it's been tax deferred, meaning you're not paying tax on a year-to-year basis, the IRS is going to want its revenue that it hasn't gotten. And what that means is at age 72, it used to be 70 and a half, but 72 now, you have what's called an RMD, and you will have to take money out of your traditional IRAs and then all of your employer sponsor plans. You have to take out a certain amount, which is based on just an actuarial kind of life table. And that's, again, just so the IRS can get tax revenue that they haven't been getting all the time it's been tax deferred. The goal of an RMD, or the goal of the percentage that you have to take out, is essentially to have the account empty by the time your actuarial table says you would pass away. So here we go, begins for IRAs at 72. And then, 401ks, 457, 72 also. One important point there: if you don't take an RMD when you should have, you'll have to pay a 50% penalty on the amount that you should have taken. In most situations, if you miss one RMD just because you didn't know, you can petition them to have that 50% penalty waived. And a lot of times they will. However, if you do make that mistake again, you will have to pay that 50% penalty. So 3 mistakes people make with RMDs. The first one, aggregating RMDs between different types of retirement accounts. So if you have a 401, every employer-sponsored plan you have, once you reach age 72, you'll have to take a separate RMD for each one. So if you have 3 401ks from 3 old jobs, you have to take an RMD from each of those 3. If you have 4 IRAs, so not an employer-sponsored plan, but IRAs, you can aggregate them all into one pool of money, figure out what total dollar amount you need to take as an RMD, and take that out from any of the 4 entirely, from 2 of the 4. Any way you want to do it, you can aggregate IRAs together. However, you cannot aggregate employer-sponsored plans together, which is another reason that it might make sense to roll your money out of the 401k and into an IRA, because it gives you that kind of flexibility there. Number 2, aggregating RMDs between spouses. So each spouse will have their own RMD. You can't, take all of the combined RMD from one spouse or the other. They both have to take individually. And then just number 3, forgetting to take an RMD, which will hit you with that 50% penalty. So our first strategy here, hold off taking IRA distributions for as long as possible. Why? Your funds will continue to grow tax deferred for as long as possible. That income will not be on your tax return. And then all of those side effects we kind of went over in the meantime. Potential drawbacks and limitations. So as your IRA grows, so does Uncle Sam's share. Again, you can't just let it grow forever. At age 72, you will have to take the money out. So I guess it's, a good problem to have, but if your account does grow higher and higher, that's more money you'll have to take out at age 72, and thus a higher tax bill. IRA distributions in future years might be higher, which could put you into a higher income tax bracket. So again, if the account's growing, it might push you into a higher bracket. Possible future side effects may not be an issue now. Increase the amount of Social Security benefits that are taxable, and then the IRMA. Future tax rates may be higher. So again, this presentation is based pretty much on the tax table as it is now. What's the tax table going to be in the future? We have no idea. I think you'd be hard pressed to find someone that think taxes will go down, but just something to consider. What will they be in the future? Who knows? So maybe if you're trying to let Social Security get 8%, each year of the credits, maybe we take some from IRAs in the meantime, because your income will be lower. and we know what the tax rate is now. So savvy strategy 2, Roth IRA conversions. So this is basically taking money from an IRA or a 401k and moving that into a Roth IRA. Once it's in the Roth IRA, it's part of those Roth funds. It'll grow tax-free. When you take it out, it'll be tax-free. The obvious caveat, however much you convert in that given year is added to your income. So you can convert, by the way, as much as you want. There's no age limit or anything along those lines, no income brackets to worry about. You can convert whatever you want to a Roth IRA. The only caveat is in the year that you convert it, it will be added to your taxable income. So in this situation, Jill converts $100,000 from her IRA to a Roth. She'll just add $100,000 to her income on her income tax return. So they're a powerful tool because once it's in the Roth IRA, it grows tax-free, and then we can have that flexibility of a tax-free distribution in retirement. And also, you don't have to take a RMD from a Roth IRA. However, you would want to consult your tax professional if you're considering doing this, just because of the tax ramifications in the given year that you do it. Tax-free Roth IRA distributions. So all distributions from a Roth IRA are tax and penalty free if you've had your Roth IRA for more than 5 years and you're at least 59 and a half. Kind of went over that earlier. If you're older than 59 and a half, the amount you convert can be distributed at any time, tax-free and penalty-free. So basically, if you're over 59 and a half and you do a conversion, it's immediately, well, if the account's been open for 5 years, it's immediately able to be distributed tax-free. Who can do a Roth conversion? Pretty much everybody. As long as they're 18 and can contribute. Well, as long as they're contributing to an IRA or a Roth IRA. No age limits, no income limits, no requirements to be working, that type of thing. So, you don't have to be working. You don't have to have compensation to do a conversion like you do a contribution. And why? A great reason to do a Roth conversion is to help reduce the risk of a rising income tax rate. Again, we know what the income tax brackets are now. We do not know what they'll be in the future. Taxes are a major concern for many retirees. I would argue most of them. Conversions allow you to pay taxes at today's tax rates. So we at least know what they are. Can help manage other costs tied to your income, Social Security benefits, and the IRMA. When's a great time for a Roth conversion? Usually between when you retire and you lose your job income and when you take RMD, when you're forced to take RMDs and you take Social Security. So maybe between age 65 and 70 or 72, that range. You'll kind of have a lot of flexibility with what you take as income and what you convert. Roth IRAs do not have RMDs, so you don't have to take the money out. You decide how and when. So it'll just continue to grow uninterrupted and tax-free. And when it goes to your heirs, it is tax-free to them as well. 3 key questions. Do you have a rough idea of the conversion's impact on your tax bill? You absolutely need to. Do you have a plan to pay the resulting taxes? Again, if you take the taxes out of the money that you're converting, it kind of lessens the power of the conversion. So we generally recommend, if you do a Roth conversion, to pay the taxes with cash that you have. Do you have a reasonable expectation that the benefits of prepaying your taxes like this make sense in your overall plan? Again, it's an analysis. Kevin and I do this a lot. But you definitely need to think about what your tax situation is now versus what it might be in the future. Hunt for low income years. I kind of hit on this earlier. But in the years if you're a business owner with unusually low sales or high expenses, high non-recurring medical bills, all of those, that's good years to do Roth conversions because your income tax rate will be low. But also after retirement and before receiving Social Security benefits, pensions, and or IRA distributions, prime time for Roth conversions, as I kind of spoke about earlier. Potential limitations and risks. There's no guarantee that a Roth IRA conversion will achieve the intended results. Like I said, we know the tax bracket now, but not in the future. I guess there is a potential that it could be lower and, it could be wasted. There's no guarantee that the Roth IRA distribution rules won't be changed. I think any money that's already in a Roth IRA should be pretty good. They could, I guess, say, that there's some kind of tax on a Roth IRA in the future, so that's not guaranteed. The amount converted, obviously added to your income. And then again, a Roth IRA conversion could trigger those same side effects because it's added to your income. And then, of course, once it's in the Roth IRA, there's no real guarantee that it'll grow. Strategy 3, move retirement money directly. So there's 2 ways to move retirement money. This is from an employer-sponsored plan into an IRA, or from an IRA to another IRA. There's an indirect rollover, also known as a 60-day rollover, where you kind of take a distribution from the account and then you have 60 days to put it into another account. We don't deal that much in that. There's a lot of moving parts in that. Can get complicated. We mostly do a direct transfer, which is trustee to trustee. One trustee, so we'll say Fidelity, will make a check out to another trustee, maybe Wells Fargo, and you'll just take that check directly from Fidelity and put it in Wells Fargo. The money never goes into your bank account. That's called the direct rollover. Strategy 4, coordinate your IRA planning. So you definitely want to make sure you consider your RMDs, contributions, withdrawals, tax-free money versus tax-deferred within your overall retirement plan, estate plan, certainly tax planning, education planning, and overall financial plan. Coordinate IRA planning with Social Security. Many retirees do not properly evaluate the decision of when to apply for Social Security. When you should claim benefits is a personal decision that depends on many factors. Social Security is guaranteed for life and has cost of living adjustments. Delaying Social Security can increase your monthly benefits, can be pretty substantial if you wait till 70. Many retirees claim Social Security earlier than they should because they think it won't be there, or for a variety of other reasons. Another plug, we do a Social Security seminar similar to this and similar to tax planning, where we go kind of a deep dive into Social Security. If you have any questions about Social Security or you want to be signed up for that seminar, let either myself or Kevin Luke know, and we'll get you signed up. Withdraw from an IRA to delay Social Security. Reports have shown that Social Security is often the cheapest annuity you can buy. Price equals other assets used to delay Social Security. So again, after you retire and before you have to take RMDs and Social Security, your income tax rate should be lower in theory than both before and after. So that might be a great time to withdraw from an IRA to pay the lower tax rate while the Social Security gets those delayed credits of 8% per year, because it is 8% guaranteed. Savvy strategy 5, coordinate your IRA planning with estate planning. IRAs and other retirement accounts generally pass via whatever their beneficiary form is. That's pretty important. Regardless of what you have in your will, almost always they'll default to what's the beneficiaries on the IRA, on the beneficiary statement of your IRAs. So make sure those are correct. Periodically check. Your will could say one thing, but they'll generally side with the beneficiary form. So make sure that's correct. Options for spousal IRA. So there's a spousal rollover, which is basically where you roll your spouse's IRA into yours. If your spouse passes away, then RMDs are based on your age. There's also the election to leave the account sort of in their name and you're the beneficiary, where you have to take RMDs based on their RMD table. Both of those have kind of pros and cons. In general, we would suggest, having sort of an evaluation of what the tax ramifications from either of them might be. But that's kind of all we've got today. Hopefully we answered a lot of questions. I know that was a lot of information very quickly. If you saw anything that was confusing or something that you might need help with, again, we offer a complimentary consultation. So find out, kind of how we could add value to what you're trying to do with your retirement plan. If you're interested in doing that, feel free to give us a call at 908-904-4100. And yeah, that's all I've got. So for Ryan and Kevin here with the Society for Financial Awareness, we thank you very much for attending, and hope you got some info that'll help you make better decisions, or more efficient ones. So everybody have a good night.